Ever wonder why Michael Saylor just keeps buying Bitcoin no matter what? He just buys over and over, no hesitation, no exits, and absolutely no fear. Price goes up, he buys. Price goes down, he buys. He doesn't care about timing because he's not playing the same game that you and I are. And here's the part that nobody says out loud, that approach only works if you can hold through anything forever. And you've got effectively unlimited capital behind you. And the reality is that most people don't. Most people are trying to grow their capital, they're trying to protect their capital, and they're also actually trying to realize profits, not just collect Bitcoin forever in a corporate treasury. So in this video, I'm going to show you why Saylor's DCA actually raises your risk at the worst times and the smarter alternative that lets regular investors exit, reset, and actually make money along the way. So Saylor is playing with a cheat code. He's got access to nearly endless money, corporate funds, investor cash, and loans that don't come due for decades. He doesn't have to sell ever. He doesn't have to worry about cash flow or short-term swings. He just keeps buying no matter what. And that's a game changer, but it's a game changer for him. And when Saylor buys Bitcoins at higher and higher prices, it actually doesn't hurt him. He's not at risk of being forced out. There's no deadline. There's no margin calls. There's absolutely no pressure because he can ride out the storm. But most of us, we don't have that same kind of luxury. And even if we call ourselves long-term investors, we do have limits. Our money is absolutely finite. We have bills to pay, we have emergencies, or just the need to cash out someday. We can't always wait forever for prices to recover. And that's where blindly buying in month after month using so-called DCA can quietly turn from a strong conviction into actually a hidden risk. And when prices rise over time, buying on a schedule, it does feel safe. It feels smart and it feels disciplined. But here's the catch. Each new buy is usually at a high price, and your average cost, what it actually does is it creeps up. And most of your money ends up getting invested near the very top. And that's just because markets just keep spending more time going up. And that's fine, again, if you never plan to sell, like Saylor. But if you ever need to exit, suddenly your safe strategy, it isn't so safe. Blind DCA works if you never have to sell. But the moment you might need to exit, your average price, which is the real cost of your investment, matters more than anything. So what actually happens when traders try to use Michael Saylor's style of DCA in a trading context? Well, they fall into a trap they don't realize that they're in. Instead of buying more when prices fall, they keep adding as prices rise. Every purchase feels justified because the market is confirming their bias and belief. But mechanically, their average cost is creeping up every single buy. The position gets larger, it gets riskier, and of course it gets harder to manage. Then when the market finally turns, as it always does, they're stuck. There's no flexibility left. There's no room to exit. There's just a bigger position with a worse entry. It's kind of like climbing a mountain and setting up camp higher and higher each time the weather looks good. Every clear day convinces you to push upwards, but when the storm eventually rolls in, you're going to be stranded at the top of the peak with no easy way down. And the problem wasn't the climb, it was where you chose to build your camp. And that's why so many traders get wiped out after strong bull runs. Not because they were wrong about the asset they're trading, but because they confused conviction with positioning. They took a strategy designed for long-term accumulation and they tried to use it like a trade. And trades, whether people like it or not, they always need an exit. So how do you flip this around and make DCA actually work for you? Well, what you do is you reverse the logic. Instead of buying simply because time has passed, you only add when price moves against you. Time doesn't matter. Each additional buy happens lower than the last, pulling your average cost down instead of pushing it up. Weakness stops being something you fear and becomes something that you can actually plan for. You're not trying to catch the bottom, you're just making sure that every move gives you more room to recover and a cleaner path to exit when the strength returns, not only when the market makes a new all-time high. But here's the part that most people miss. This only works if it's executed consistently. To actually use this approach, it has to be built. An algorithmic system is the best kind. Something that buys when price falls and exits when price rebounds and does it without hesitation and without second guessing. That means no gut feelings, no waiting for confirmation, no FOMO just because price is running. Just a set of rules that behave the same way every single time. So you don't sabotage yourself when emotions inevitably show up. And that's the real difference. Understanding the idea is easy, executing it over and over again in real market conditions is what turns it from a clever concept into a real edge. So before we jump into the demo, because I'm going to show you exactly what that looks like now, I want you to pause for just a second. What you're about to see isn't some theory scribbled on a whiteboard or a chart with perfect hindsight. This is actually a live, unfiltered look at how this approach really works when the market is moving, how positions get built, how your average price changes, and how you can actually exit without needing to guess the top. So if you've ever watched trading advice that sounded smart but totally collapsed when things got wild, this is the missing piece. Most people skip showing what happens when the market gets messy because that's where most strategies fail. So clear your mind, focus in, and watch closely. This is what happens when you let a system, not your emotions, take over. All right, so in this demo, I want to show you exactly what I mean by using this inverted defensive DCA approach, and we like to call it safety orders in our trading system. So what we're doing here is, let's just take a look. We've got a first entry after a take profit there. The trend was down and we entered here. And then what you've got here is two lines. You've got this orange line that's walking like a staircase down and a green line that's tracking it. The orange line there is the weighted average price, and that's what I want you to keep your eye on. The green line there is simply our take profit. It's just tracking it in parallel. Now, what you can see is it's actually descending down as we're placing these safety orders. Now, these safety orders are using DCA logic and volume scale in order to lower that weighted average price each time. So as you can see here, the first entry was at 99,000, but if we come over to here to see when the trade was closed, we see that we actually took profit at 91,000. So using a long only strategy, and I can show you exactly what it looks like in full there, we're able to use this defensive DCA approach, which we call safety orders. Every one of those blue ones here is called a safety order. We're able to actually bring our average weighted price down using this DCA, this first principle DCA, and then we're able to get out on a sub rally on a much, much lower price. And you can see there that it works absolutely beautiful. And what we're actually doing here is we're constantly using DCA and safety orders in this way. Obviously, if the market goes up like this trade here, when we go there and take profit, we don't need to do any kind of DCA. We're not buying at higher prices. We're taking profit. We're realizing gains at those higher prices. But what we're doing is we're using DCA logic and the first principle of DCA in order to protect the initial position and give us the opportunity to get out of a trade at a much lower price. And you can see there what it looks like in action when it's completely automated and executed using an automated trading system like the one that we have at Minotaur. So Michael Saylor isn't exactly wrong, and he's definitely not wrong to tune out the short-term noise. His strategy works because it fits his situation, his resources, and his timeline. But let's be honest, most people watching this aren't Michael Saylor. You don't have decades to wait, you don't have billions to ride out every storm, and you can't afford to be eventually right, while your account balance gets absolutely crushed. You need something that works while the market is moving, something that fits your reality. That's the whole point of this video. For the last 3 years, that's been our mission, taking big ideas and turning them into systems that work for real people with real money in real markets, people like you and I, not just in theory, but in practice, across all kinds of accounts from lots of different countries, and of course, across lots of different market conditions. I've seen it over and over. People have conviction, but what they really need is structure, a way to use things like DCA that don't build risk, but actually manage it, and a way to exit without praying for a new all-time high. And that's exactly what we've built at Minotaur Trading Systems. And if you're curious how this could work for you, we're offering free consultation calls and of course live demos, so you can see exactly how this strategy operates in real time and how it can be tailored to fit anyone, anywhere in the world. So if anything in this video clicked for you, if you see now why copying Saylor's moves doesn't work unless you're living his life, check out the links below. Everything you need is in the description, because Saylor doesn't need to change his strategy, but maybe you do.